Guys, welcome to the show tonight. I got two really important things to talk about in this particular episode. I want to get right started, and so I want to start the charts right here, and let's get right into it. The first important thing I want to talk about is this bond yield inversion that's going on. Now, you know, all debt is priced in these yields. So if you're going to buy a house or anything, you know, it follows these bond yields. Now, what we're seeing tonight, looking at these yields, is we're seeing an inversion almost all the way across the board. The U.S. 3-month is at 2.459%, or might as well say 2.46%. And we're looking at a 2-year at 2.3%, a 5-year at 2.24%, a 10-year at 2.43%. So this 3-month is higher than the 10-year even. But it's not quite as high as the 8-year, but it's moving in that direction. Now, here's what I think can happen. It's very dangerous to the financial system. When this 10-year, I don't know how long it might take, but if it keeps moving in this direction, it's been moving in this direction lately. If this 30-year, the 10 years already crossed. The 10 years already lower than the 3-month. If the 30-year gets lower than the 3-month, then we got a full all the way across the board inversion. The problem with this is who on earth is going to buy a 30-year bond when they can buy a 3-month bond that's going to yield higher than a 30-year? What this could lead to is a sudden sharp reversal in the bond market. Once the U.S. 30-year crosses the 3-month, in other words, once the 3-month is going up, the 30-year is going down, when they invert, we could get a sudden snap in this bond market where these yields could rise precipitously fast once we get that full all-out inversion of all the way down to the 30-year. This is a problem that we really got to watch, and it's a sure sign that a recession's coming, like within the next year or so. But the thing is I know the recession is coming a lot sooner than that, because this slope that we're on, this downward slope in the world's economy, especially China. China's really dragging it down. Germany is almost in a recession. Let's just check the German bonds just for a second here. You know, quite seriously, we're looking at negative yields here. You know, look at it. I mean, who in their right mind? The negative yields go all the way out to the 10-year. In other words, you're going to lose money. Who in their right mind would buy a German 10-year bond at negative 0.19%? Who on earth is going to buy that stuff? But, you know, these are negative yields. This is what we're going to see coming, guys, later, but not yet. Right now, what we could see is what I said. We could see this sharp reversal in the bond yields. There's all kinds of bubbles out there that are ready to pop. Housing market bubble is extremely dependent on the bond yield. Now, I want to take a look at one other thing here, the Italian bonds. Now, this is very important. The yields are on the rise in the Italian bonds, but now if we go to the Italian 10-year, and if we take a look here at the overall what's happened recently, you can see market manipulation here. Italian yields were rising. They were up to like 3.66% on the 10-year Italian bond. And look at what's happened. Look how the yields have been falling. This is market manipulation. They're buying the Italian bonds. I don't think it's investors buying these Italian bonds. I think it's the European Central Bank. That's my opinion on it. I think they're doing it to keep Italy solvent, because if the Italian 10-year goes above, say, 6%, which it could overnight, because if Italy starts to get in trouble, these Italian banks will not be able to fund anymore. It'll be impossible once they go over 6%. It'll be impossible. Italy will crash out. That'll be it. Time done. Over. You know. So Italy is already in recession. We're back on the German bonds. Let's take a look here at what's happened with the bonds here. Over here. Where is it? Treasuries. Here we are. We go back again to U.S. Treasuries. Here we get the full list of them. The 1 month is at 2.47. It's even higher than the 3 month. You know, but this inversion goes all the way out to the 10-year. The 30-year is the only one that's not inverted yet. But now, if we take a look at the 10-year and we take a look at the chart here, what we're seeing is these yields dropping like a stone. Just look at that. Look at the U.S. 10-year yields dropping like a stone. I predicted that these yields would rise. They're not rising. Sorry to say, they're falling. And the thing is we could get a sharp change in direction in these yields. They could snap back really suddenly. Now, I want to talk about something else here. I want to talk about the Brexit again. The complexion of the Brexit's really changed really quickly here. And it's all coming down to the vote. Now, from what I understand, the latest information that I got, and I know this information changes so fast, that the vote's going to occur midweek. They haven't put a dead set time on it yet. But I heard somewhere around midweek, maybe Wednesday or Thursday or even Tuesday, they're going to make the vote. And they're going to vote for Theresa May's deal a third time. If you can believe that. It's the same deal. They're voting for it over and over and over again. It's the most ridiculous thing I've ever heard of in my life. You know, but evidently they're going to try to keep voting on it until they get what they're looking for, you know? And so I guess they're going to vote on it again, but this time it's crucial. This time it's crucial. The European Union has given them a 2-week extension past the 29th of March. So they got 2 weeks. And the European Union has said that if this vote that they're going to do right now, if this doesn't get a yes vote midweek, this week, coming, then there's going to be no more deals, and I can't see them voting on it a fourth time before the end of this thing. I mean, it's starting to get ridiculous now. I can't see them voting on it a fourth time. There'll be an uproar if they tried to vote on it a fourth time. So what are they going to do? They're going to make this vote, and it's all come down to the vote, because if they say no, we don't want it a third time in a row, well then the clock is going to be ticking toward that 2-week extension, the end of the 2-week extension. I think it's the 12th of April, the 2-week extension. Once that hits that day, then it's over the cliff they go, because Article 50 is in power. And when I say over the cliff, I don't think it would hurt Great Britain. There's a reason why it's called Great Britain. The people of Great Britain are tough. And I don't think it would really hurt Great Britain that much. I think they're making much to do over nothing because they want to get this thing passed, this bad deal. But what they've done is they've made it such a center of attention, and they've made it seem like the whole world's going to cave in around it, that it could act as a trigger for the financial system. Because our markets are overpumped, everything is pumped up, and we're right on the verge, we're right on the edge of going into a recession. So, it's going to come right down. It's not going to come down to that 2-week extension. That's not the date we're looking for. The date we're looking for is the vote date, and what the vote is going to be. Because if that vote comes in negative, a no, the markets are going to react to that very unexpectedly. And what I mean by that is the markets are all sitting back there right now saying, oh, this can't happen. Britain can't possibly have a hard Brexit. It's impossible, the markets are saying. They'll do something. Markets are, because that's generally what happens. Generally, you get something like the Greek crisis, and then they come out and they bail Greece out or whatever. It's always, they always lead you, or say the debt ceiling, right? United States debt ceiling. They build up anticipation, you know, and well, we're going to go over the debt ceiling and all this kind of stuff, and at the last minute they make a deal. So the markets have got used to that because it happens over and over and over again. You're heading toward a deadline, and they know that these politicians will find some sort of a way out, and they say to themselves, it's just another one of those things, you know, where the politicians will make a last-minute deal. And that's what the markets are doing right now. They are actually pricing that in. Britain is going to make some sort of a last-minute deal, and this whole thing's going to go away. Now, they did the same thing, the markets did, when there was a vote for Britain to leave the European Union a few years back. They did exactly the same thing. They priced it in as it would be, because the bookies, you know, in England were saying, well, they're not going to leave the European Union. The bookies were betting on that, and the markets went along with that and said, oh, it'll never happen. They'll never leave the European Union, and it's gonna be a positive vote to stay, you know. But it wasn't. It shocked the markets, and we seen the reaction of that shock. Gold and silver shot up. I remember that night. Silver was shooting up like past $21. It was just going like a bullet. It was going straight up. Not sideways up, straight up that night. Because the markets were shocked. Okay? This is the same sort of thing. The markets are complacent right now. And they're saying to themselves, hey, you know what? It's never going to happen. They'll make some sort of a last-minute deal. And there'll never be a hard Brexit. And we're not worried about it. No, we're not worried about it. But here's the thing. If they say no to this deal, then are they going to put it to a fourth vote? I don't think so. And the clock's going to be clicking down to a hard Brexit. And you all know how stubborn Theresa May is. She'll hang diamonds. If she doesn't get what she wants, she'll have a hard Brexit. You know? And so what does it say here? It says, Britain may face a daunting task of changing the minds on Brexit. In other words, a daunting task of getting a yes. You know, here she is. British Prime Minister Theresa May holds a news conference. British Prime Minister Theresa May on Friday began the mammoth struggle of persuading a deeply divided Parliament to back her Brexit deal after an EU summit granted her more time but little to help change the minds at home. After a bruising day in Brussels, May secured a 2-week reprieve to try to get the deal she negotiated in November through Parliament, a third attempt, or face a potential chaotic departure from the European Union as soon as April 12th. So, April 12th is right now what the markets are all thinking. They're thinking to themselves, hey, you know what, we'll see what that's going to happen by April 12th. That's not it. That's not it. Because if the markets get shocked when they do this vote, if the vote comes in no, then suddenly the prospect is going to be facing them right in the face with both barrels, a hard Brexit. The market will be shocked, and immediately there will be a response. It won't wait until the 12th of April. It'll be an immediate response in all the markets. Once that response comes, well, look, we just saw an over 400-point drop in the market just Friday. Okay? Now, we're going to go into Monday. What's going to happen? Market will probably come up a little bit because went down quite a bit, right? And the thing is the vote's not until about Wednesday. If we get a negative vote on Wednesday, we could see an awful lot of fireworks happen very suddenly. And that's the point I want to make here. EU leaders were clear that it was now up to the British Parliament to decide the fate of Brexit. Okay, so it's all down to this vote. To leave with a deal in a couple of months, or to depart without an agreement. The Brexit deadline may have been moved from March 29th. However, Parliament shows no signs of budging. See, that doesn't sound good, does it? Parliament shows no signs of budging. In fact, incensed by comments from May on Wednesday night that pinned the blame for Brexit chaos on them, many British lawmakers have now hardened their resistance to the deal she is due to bring back before them next week. It doesn't sound good, guys. So I think they're going to vote on it on Wednesday, and the way it sounds to me, it's just my opinion, but what I'm reading here, it sounds like they're going to vote it down again. And we could see a sudden shock in the markets when this vote's taken. I think Wednesday or Thursday, it's coming along right in there, midweek. So prepare yourselves likewise. Listen, thank you for listening to this show, and we'll catch you guys in the next show. Bye-bye, guys.